Well, welcome to the podcast and welcome to 2022. Yep, we've made it into another year. Who thought after 2 years of this pandemic we could still be here? And ladies and gentlemen, we're going to go back with an old favourite. He's been on the show a couple of times. He's the Executive Director of Wimmer Financial and Wimmer Family Office. They are a boutique investment bank around the world. They look after real estate, hospitality, mining, and a few other things. They look at everything that's going on in the world economy. Mate, welcome to the show, Mr. Peter Plaut. How are you, mate?
Rob, great seeing you, mate. Always a pleasure.
Now, we've hit 2022, and when we originally spoke 2 years ago, this coronavirus was just starting. We were talking about how it was going to affect the world economies, be it development, be it investment. And we all had our best guess of what was going to happen. We're now basically 2 years into it. Most of the financial economies around the world are getting sort of used to this up and downness. If you looked at the stock market and you looked at the data and what's going ahead, what do you see happening in the next 12 months, considering we're still in a little bit of flux with new variants and a few things that are affecting economies around the world?
Well, I think, Rob, if we look back the last 2 years, let's start there. Okay. What we had was we had the coronavirus come in March of 2020, and the predictions for the world economy were as dire. The central banks and the governments around the world got together in the developed countries and made an unprecedented monetary and fiscal response, much greater in magnitude and much more forthcoming in terms of shortness of time than we saw during the global financial crisis. So whereas in the second and third quarter, we saw sharp drops in aggregate demand for the economies, the amount of liquidity that flushed around the system allowed for businesses to survive. It allowed for governments to then come in and do small bailout packages for small and mid-sized companies and individuals. So the economy, while it had a sharp downturn, something that we haven't witnessed since the Great Depression, okay, it was relatively short-lived, and then the economy's bounced back quite quickly. The financial markets did exceptionally well because of all the liquidity that was frothing around in the system, and that liquidity still remains. However, there's a cost to that liquidity, okay, and that's inflation. That's both in terms of the monetary unprecedented response as well as the large fiscal response that led to a massive buildup in government debts. If you add that to the supply chain shocks that we're witnessing in various countries around the world, there is significant pent-up inflation in the system. You could just look at the numbers that we've seen monthly coming out over the last couple of months. The amount of inflation in the system is quite unprecedented, and that's going to hurt the average citizen, the lower to middle income person, when you have oil and gas prices where they are now, when you have food prices where they are, and you add to that a supply shock because of the ramifications of COVID, that further promotes problems with pricing. Now, eventually that will get worked out of the system over time, okay? But in the short term, there is definitely a big inflation risk. That's number one. If you combine that with the fact that we have very lofty valuations in equity and debt markets, as well as other markets around the world, okay? The unprecedented sharp run-up in financial markets will not be repeated in 2022, okay? And also, if you look at it, there was definitely a dichotomy between the rich and the ones that have not, because the rich had significant money in the stock market. They were able to play in the crypto markets. They had real estate holdings. I heard a statistic recently that the top billionaires around the world had something like $7 trillion in 2020. In 2021, that grew to $13 trillion. So the rich got wealthier, the poor got poorer, and that dichotomy is a concern. More importantly, if you look at the run-up in the stock markets, particularly the U.S. markets, the S&P 500, NASDAQ, Dow Industrials, okay, that was predominantly led by the big technology companies, okay? So the rest of the pack didn't perform as well. They did okay, okay? So again, that's likely not to be repeated. So I think when you take the inflationary aspect, that will eventually lead to, not in the next year, not in the next 18 months, but over time, higher interest rates, okay? because of the trying to stem the runaway inflation.
Mm.
You add that up with lofty valuations in financial markets already. Okay, we're going to see year 2022 with probably a lot of volatility, and that'll likely continue into 2023.
So, mate, let's break that down a little bit. Let's look first at governments. Governments borrowed money everywhere around the world, far more than they've ever wanted to, but they needed to keep the economies going. Will that amount of money that's been taken now out of the system affect liquidity for other investments for people who are looking to fund major real estate, major infrastructure privately because the banks are sucking so much out of the world economy? Let's say that.
Well, let's break that down. Okay, first of all, there's unprecedented levels of liquidity in the system. Okay, that's not just going to go away in the next couple of years. The Federal Reserve already said they're going to take back some of the quantitative easing that they put in place over a decade ago with the global financial crisis, but that'll be measured. It'll be a measured response. It's not going away overnight. So still plenty of liquidity. Interest rates globally remain extremely low. So even if they go up 150, 200 basis points, not going to be that significant. So private investment, private capital flows will continue to come in. Okay. And they'll still support asset classes. I just don't think you could see the significant run up that we saw in 2020 and 21 repeat itself in 2022 and 3.
Mate, what about crypto? In the last couple of days, we've noticed that is a volatile market in itself. And as of this afternoon, it was down huge amounts. Do you see a long-term viability for that, or do you see it sort of settling in with a lot of other investment arms where people put their money?
Look, I'm not an expert in the crypto space at all. I do sit on some advisory boards, and I also participate in some venture capital TV chats on it from a family office perspective. So I know enough to be dangerous. But what I basically say, like any prescient asset class, it's going to experience significant volatility, and that'll continue to place. But the genie's out of the bottle. It's not going anywhere. It will continue to grow. Things that have to do with blockchain will continue to garner significant asset flows, and we'll see more and more of that. So over time, it will become a more permanent asset class. But right now, it's still going to be quite volatile.
One of the major banks in Australia came out and said that with interest rates low, a lot of the banks are relying on the interest they earn from credit cards. But what they've seen is over especially in the last 12 months, credit card debt reducing hugely and people saving immensely. Will that affect the World Bank's profitability?
Well, first of all, if you're looking at the world banking system, the credit card margin is still so significant in terms of what the banks can borrow at, which is basically negative real rates and charging interest rates anywhere from 15 to 30%. So that spread is dramatic, and the banks benefit significantly from that. So if there was a small amount of people reducing some of their credit card balances, which actually I don't see, I see more of it increasing. Okay, that's a big home run for the banks in terms of their margin there.
Do you see, looking at the share market, it seems, especially in the last month, a little bit more jittery than what it maybe has been, but it corrects very quickly. Do you think that trend will keep going during 2022, or do you think they may take a step back and maybe not move as quickly?
Look, over time, the stock market and the real estate market, there's no really other place to put your money, okay? From a long-term capital appreciation point of view. The bond market with negative real rates and credit spreads so tight, I don't know why anybody would be in bonds right now. But going back to looking at the forecast for 2022-23, we've got inflationary expectations that continue to rise, which is not good for fixed income securities or bonds.
True.
Okay. We have a oil and gas situation where OPEC has basically said that they're going to continue to not be big providers of supply and may not have the resources to do so as well. So we continue to see oil and gas prices likely to shoot upwards. That affects the average person. We have the supply chain disruptions around the globe, which are inflationary. All those things stack up. And then we have the COVID, the fits and starts again with economies. All that doesn't lend to a wonderful backdrop for 2022 and 23 equity and debt markets. versus what we experienced in 2020 and 21, where we had an unleashing of massive fiscal stimulus, massive coordinated monetary authority response. So that's done and done. So now you got to look a bit more at the fundamentals. And the fundamentals, you could say, oh, it's the new year. Let's hope and pray for the best. You got to do your homework. And when you do your homework and you dive into it, it's going to be a more challenging environment.
So we say overall for banks around the world, it's going to be a challenging 12 months for them before we start talking about real estate and where that's all going.
I think it's going to be challenging for all financial market participants.
Yeah.
But there's pockets for hope and opportunity. And we'll start talking about, for instance, where my family office is investing and where we're looking for opportunities.
Now, we've seen in Australia, the residential market jump very, very sharply. People weren't going overseas. They started to keep their money in the bank. And all of a sudden they've started to say, well, you know what? I don't need to live near the city to do my job anymore. I can move to the country. I can move to the coast. And so we've seen a lot of coastal areas where they were probably 20, 30% cheaper than major cities are now pulling up to within 10% of a major city. And the major cities are rising at the same time. Do you seeing that? Is that being reflected around the world in the residential market before we get into the commercial and the industrial?
Oh, absolutely. I mean, we're seeing that in the UK. I live in Wimbledon, which is about 30 minutes outside of, London. And over the last 2 years, it's been a significant run up in prices here. If you go into the States, if you go outside of the suburbs of the major cities, whether it's New York, Chicago, LA, San Francisco, pricing run up as people that love living in the urban environment, but we're always thinking about pulling the trigger to get more land. The COVID kind of accelerated the trend to move to the suburbs. There's another trend going on in the States in particular, and that's going to finding areas that are warm and areas that have favorable tax jurisdictions. So we're seeing a massive migration out of places that have high taxes, like in California to Austin, Texas. A movement away from New York down to Miami and other parts of Florida where the weather's great and the taxes are extremely low. There's some places like Puerto Rico that has extremely favorable tax rates to attract people to come down there after the problems that they had in Puerto Rico a while ago. So this is a trend that's occurring across. If we look at Western Europe, you're seeing more people taking their second homes in Spain and Portugal and making them more permanent. So there is definitely that shift, Rob. However, people by their human nature want to interact with other humans.
True.
And that doesn't mean staying at home with your wife and kids or husband, etc., 24/7. So they want to go out. They want to be out with their colleagues and their friends. Okay, they want to be in urban environments. So people will eventually come back to those urban environments, and we're already seeing that. I mean, you look in California and LA, prices are going up in the houses despite the taxes. You're seeing that in various cities as well. The other thing is that offices where people had this policy where because of COVID, you could just work at home virtually, and the school's the same. That's changing now. People are going back to work. They want to be at work. Their employers want them at work. Okay. And the schools, they're the same thing. So you're going to have this, I guess, more flexible work, personal life environment in the near and medium term, where people will be able to spend some more time working at home and won't be penalized for it. And the same thing, working from the office. But there's some offices that people are critical to be in that office. And it's particularly when you're working for a defense contractor or government focused areas where you need high level security, and they will have to be in an office. There's no doubt about that. But what we will see is a lot more of these residential/office facilities where people can work and play and live all in the same building or area. And I think there's going to be a fundamental shift to that kind of work and living type of environment.
Now, we are going to get back to that because I was only staying in Sydney with my wife a few weeks ago and we observed some very, very different things. But before we go there, you work for also Wimmer Family, which is 5 families who invest all over the world. Now, you've got your finger on the pulse when it comes to real estate investment. a company like that, what are they looking at in the next 12 months, and where do they see the opportunities that the normal person may not see or might not have the access for?
Well, let's break that down in a couple of things. First of all, I think in the current state of the markets that are lofty, as I mentioned, in the publicly traded markets, there's huge opportunities in the private equity or private and the private credit markets. And what does that basically mean? That's basically providing equity and or debt financing to companies that need it outside of the publicly traded securities. So you're basically providing a loan, you're providing a direct equity investment into a company and taking a much longer term view. That view might be 3, 5, 7, 10 years or longer. So you're taking a longer term view. Now, you might say only the big money managers and private equity guys and all the smartest guys in the room can invest in that. It's actually not true, actually. There are private equity funds and credit funds and others, okay, that have LPs that might take smaller commitments. There are mutual funds that are focused on that as well. But more importantly, if you're a teacher with a pension, you're a policeman, a fireman with a pension, in many cases, those pensions are significantly large. We're talking about tens of billions of dollars, okay? And that money is invested with these professional money managers. So as a teacher, a fireman, civil servant worker, their pension is invested in these private equity funds and credit funds, as well as the markets. So they do indirectly benefit from the knowledge and powerfulness of these different money managers around the world. So people can participate if they're participating through their pension funds and stuff. But going back to your question, Rob, specifically, we're looking at private markets for equity and debt. And when we look at real estate, we're looking at investing first and foremost in, number one, the management team. Do they have a credible management team that's been investing through economic cycles, not just the last 2 or 3 years because they saw the market run up, the last 10 or 15 years? Okay. Are they investing in an ESG compliant format, meaning, having environmental friendly, socially impact investing and good corporate governance structures? If you get that right, the management team is right, and then you can make some assumptions about their ability to operate properly through cycles.
Yeah.
So where are we investing? We believe the residential market will continue to do well, not be as lofty as it was in the past, but looking for good, residential developers that have a track record. And remember, if we provide capital now for a ground up development, won't be ready for 2 or 3 years. So it's, there's a time lag there in case there's any volatility in the market. We're fundamentally like office in certain locations, particularly if you could buy an office building at a significant discount, like 85% of its replacement cost. What does that basically mean? It means it would be cost more money to actually build it ground up than what you can buy it from existing. We also think there'll be a lot of stranded assets in the office space, those asset classes, those office buildings that have not been up to speed in terms of carbon neutrality, green, et cetera. So they'll trade at a significant discount. So you look at that. There'll be opportunities for value add where you look at an old building and maybe upgrade it, whether that's residential or office. And I think there's lots of opportunities in the hospitality space. People might think I'm crazy for saying that, but we, throughout the pandemic, have taken a very contrarian view at Weimer and been very, very significantly involved in the hospitality space. We've been investing in operators that have long-staying staying power, ones that have big balance sheets that might have been depleted, but nonetheless have the wherewithal to get through the crisis that we mentioned. We're also focused on very high-end operators. People that have money will always want a social distance, whether it's COVID or not. They want to be around other people. They want to basically have their private little getaways. We were talking about Fiji earlier, or something like that. They want to be in their own little bungalow there. And they'll pay upwards of $1,000 to $3,000 per night for certain high-end luxury. Those properties will continue to do well, particularly as the wealth continues to grow exponentially around the world. At the lower end, the extended stay type of model, where you could basically, almost like you have with Airbnb and some of the other companies, where you could stay for a longer period of time, whether it's a week or 2 weeks or even a month or longer, and basically have your own kitchen and home apartment. I think those type of product offerings will continue to do well. So we're looking at both that lower end and the higher end. You'd be surprised. 2 years ago when we spoke, Rob, I thought the regular hotel in major urban cities would be devastated. And they have been decimated, don't get me wrong. But I would tell you, over the last 6 months, before the Omicron variant came, okay, we started to see a huge pickup in demand for not office, coming to these big business conferences again. And we've seen business conferences with 1,000, 2,000 people. People wanted to go back to these conferences, and they started to pick up. And all of a sudden the variant came in again. They started to go back down. But so there's been some pickup in actual this type of section where hospitality and the hotels focused on business has actually picked up somewhat. Nowhere near as robust or nowhere near the levels we saw prior to the pandemic, but it started to pick up a bit. So that's where we are in the hospitality side.
Mate, what we saw, we were speaking to some of the operators when we were in Sydney the other day, and they said the single little, I call them the little box hotels, like your little 5 stars, but you're in a smaller room, are struggling to fill them. But what we call in Australia the apartment style that has a kitchenette with a separate lounge and dining, they're full every weekend. And I said to the guy, the maitre d' on the front of our desk, I said, why is that? He said, because people want to come and stay in a 5-star hotel or a 4-star, but they don't want to be too close to another person next to them. And so a lot of these buildings now are looking at, if they haven't already, converting old office blocks into apartment-style hotels with all the facilities of a 5-star, but the rooms basically double the size, and they can get more money. But the occupancy rates are running at around 90%. And as you and I know, I think it's 40% for a 5-star hotel, or 4 is their break-even point. And they're struggling to get over 50 or 60, where others, are right up the top. Have you seen that overseas as well?
Oh, yeah, I think that trend is something that's going to continue. I wrote a white paper that was recently published on the World Financial Review. I think I sent you a copy, Rob, where I basically had the old traditional hotel models, even those with the large balance sheets, staying power, are dinosaurs, where you basically rent a room for a night or several nights, that you have a bathroom and you have a bed, okay, and it's just 4 walls. I don't care if it's the high end or the low end, okay, it's the same. One just might have more marble and some more pretty service offerings and a nice fragrant smell. And that's nice, don't get me wrong. But in order to compete in the global economy now in hospitality, you got to offer more, particularly for Generation Z and the millennials and others coming about. They're going to want experiential services. They want to use technology. They want to be able to book a room on their mobile, show up, not see somebody at the front desk, go right to their room, touch the door, order from their mobile. They want to see not just point systems for staying at the hotel, but more offerings there. They might also want to see people of similar of interests, whether people want to have interest in their Bible readers or their bicycle riders, they like electronic dance music. They're going to want to have social media groups that bring all these people together for a week or 2 weeks at a time during the year, so like-minded individuals can come together. The hotels of the future are going to have to offer a much more differentiated product, a product where social media and technology all come together. AI is going to be more and more important to kind of judge what people's needs and wants are. If your car, Rob, has more technology on you and data than your home or your hotel room or an office building, that's a problem. So I've mentioned that in the past. That will change. So hotels of the future are going to have to offer a much more interesting product offering than just 4 walls and a bathroom.
I can actually back it up. A month before that, we went in, I won't mention the chain, but it's one of the world's biggest chains of 5-star hotels. Great deal came up. Obviously, they were way below occupancy. And we're in the room and we were looking for the room service menu. There isn't one. The fridge was empty because of COVID. And we thought, oh, well, why can't we order something? We couldn't. It just had hit this link. It was a link to a menu log or one of those places where you ordered off and one of the local restaurants brought you the food. This major international hotel was getting their stuff delivered by someone outside.
See, I've been traveling a lot lately, and I hate that.
I didn't like it one bit.
But I got a brown bag with a hamburger or a steak or French fries, and I had to open up the bag, and I had plastic utensils, and I'm staying in a 5-star hotel. I think that's horrible. However, okay, if you can combine that with some of the highest end restaurants, okay, delivering to you on a proper china and stuff like that, I think that'll go very well. So like I said, these more personalized concierge type of services to the hotels that you can use with technology and book is the wave of the future. So I think there's going to be that.
Yeah, we've also seen a lot of the resorts in the northern Australia on the islands and all that closed during COVID, and some were sold and used as a great opportunity to refurbish. And there's been some whole islands been refurbished up there, and they're getting ready to reopen if they haven't already, because in Port Douglas itself, which was in far north Queensland, it's basically a resort town, and they'd flown from China and Japan. They had whole resorts. There was one, a 300-room resort didn't open because COVID hit. So they just put a couple of people in there to sit there, and now they're looking to reopen. But they've all said they basically had to revisit everything they offer, everything they do to get people to come back. And they're the good ones. So others, you see that you hear stories, you read them in Australia where some big hotel chains or big places have just closed. You see them on the market, management rights up. They've walked away from a high-rise building because it's just not worth it for them. The owners haven't invested in the building. They've just got the management rights and put their brand on it. It's not worth it to them, mate.
Well, Rob, you bring up a good point. Look, I wrote about this a number of times over the last couple of years. The hospitality industry, hotel industry globally was decimated by COVID.
Yes.
And in certain areas, it's coming back extremely strong, as I mentioned, in the high end, the extended stay model, but the rest not. You brought up the statistic, it's correct. 40% occupancy, hotels just break even. And that's an average statistic. Some countries, the US is the largest destination for tourism dollars in the world.
Yes.
Okay. However, as a relative portion of the economy, it's a small percentage of GDP. When we look at Italy and Spain, okay, it's 15 to 20% of their GDP comes from tourism and the global traveler and the global nomad. So imagine how those economies were decimated and still have not come back to pre-pandemic levels. So yes, there's a lot of hotels that can be distressed assets. Okay. And so what's going to come in? You got people like us coming in and saying, hey, can we reposition that asset? Maybe to, like you said, maybe it's a combination hotel. Maybe it's a residential build to rent model where you refurbish it and make it into a rental residential building with some hotel services as well. But it's morphed, it's changed to something that the current city, current local environment needs.
I think the very first one in Sydney has just been approved for a build to rent. It's on the side of an old office block. And I think I was watching Asia and Thailand. In parts of Thailand, I think it's about 22% of the GDP there is hospitality. But if you go down to Phuket and parts of Chiang Mai and some other areas, some of the islands, it's like 80% is relying on hospitality. Now, they've said straight up that it's the high end that's bounced back quicker than the lower end. And the major players have moved in. Apparently, there's one island where Chinese investors have moved in and bought 3 or 4 hotels because the locals went broke.
Remember this, Rob, what my initial comments were. Of the billionaires in the world, okay, I'm just talking about the billionaire section, okay, their net wealth went up from 7 trillion to 13 trillion. Imagine the governments as well, how they've benefited. So tremendous amount of wealth creation in the last 2 years for the haves versus the have-nots. So that money needs to go somewhere, and it's going to go to the higher end places, higher end hotels, higher end real estate, and other markets. And that's exactly what we're seeing.
Have you seen this? This is one's a little bit different to what we've been talking about, but you're dealing with top management people around the world, top investors, and top people who know their industry. Are they keeping themselves up to date, but with their own resources, with their own investment in their skills, or have a lot of them sat back and thought, well, I don't have to do anything because I'm working from home, rather than continuing to invest themselves? Because if you've got someone who's invested in themselves and you're dealing with them, they're going to start making more money and sealing more deals for a guy who's sat at home and hasn't looked after himself, hasn't increased his knowledge, hasn't read up on all the latest stats and done his work around the world.
I think this is, again, another tragedy with the pandemic is the governments gave, back in the US, for instance, the UK and Australia, governments gave checks out to individuals. Okay. Governments gave companies checks to keep people, working at home with maybe 85% of their wages or whatever. In the US, they were giving out checks of like $1,200 per person per child. But at the end of the day, that money didn't go to pay the rent. It went to buy an iPad or the newest iPhone.
Yes,
okay?
they did.
So the lower and middle income people didn't use that money for investing in education or other things. They just blew it on dynamics. So that led to a quick pop in retail sales, but not something that is, sustainable. So people that were able to be the most productive at home were those that could actually do jobs at home. And that didn't have to be a Wall Street type of thing in terms of doing deals. That might be doing PowerPoint presentations, Excel presentations. Could be an Amazon fulfillment person, on the phone. But people that had jobs that could do that from anywhere, I think were highly productive and maybe even more productive than sitting in their actual offices, unless they needed guidance. So I think, again, the haves and have-nots really became more problematic during this pandemic. And on top of that, you had the social depression. People weren't interacting with other people and couldn't, which made it that much worse.
Yeah, look, I've seen that. And I've seen a lot of senior managers haven't coped with the change, the COVID, the economy, and everything moving so quick. You've seen some people which you thought would cope quite easily, and businesses that would cope quite easily, including construction and investment companies. And then others have just absolutely gone gangbusters, as we say in Australia, are really kicking goals, and they've kept their people upgraded, they've kept their people educated, and they've really embraced the change that's coming. If you're looking at it now for the next 12 months, do you see any major change from 2 years ago in the investment market and how you deal with investments and how you deal with companies that has changed now forever compared to what you were before this all hit?
First of all, there's a couple of things. One is, I think we're in a new normal where the pandemic, is basically going to, I'm not going to say contained. What we're going to see is human beings are going to learn to live with this type of pandemic that will constantly morph into other pandemics, et cetera, that we've seen over the course of human history, and we'll learn to survive with it. It'll be an annoyance. People have to get booster shots, et cetera. It'll be an annoyance, but the human beings will learn to deal with it. And like we've had done for hundreds of years. So that will return to a more normal type of situation. We won't be having these closing of economies and opening economies and closing and opening. That we'll just learn to live with it.
Those days are gone.
So we're going to learn how to live with things. So we return to a more normalcy in that sense. In terms of the financial markets, in terms of people investing, I hope this occurs for the longer term. But in my experience, what I've seen, investment professionals, private equity, credit funds, asset managers, family offices, we're doing more and more of these Zoom chats and team chats, but we're doing them with competitors that were typical competitors. Now we're considering them all colleagues. We're learning from each other. We're learning about what people are investing in, what they like, what they don't like, how they're structuring deals. And we're getting on chats like this with you, chats with people within our own industry, chats, et cetera. So I'm seeing a much more collegiate view of people working together in terms of deals and deal syndicates than existed prior. So that cutthroat competition, while there and will continue to be there, it's become a little more collegiate and a little more friendly. I think people are more empathetic. I'd hope that continues going forward, and not just empathetic in the workplace, but more importantly for humankind. We've had a terrible, terrible situation globally, and in particular in the United States, where the country has been divided along racial bounds more than any time ever. And I'm not going to point fingers at any particular party or not, because it goes all the ways back for generations. It was not helped under the Obama administration or the Trump administration or the current administration. The divisions in the U.S. have never been more pronounced. And that's really a shame, because there's a country with tremendous amount of cultural diversity, tremendous wealth, and should be able to bring people together. And it's not. It's made it worse, and that's a shame. So I'm only hoping that people can be more empathetic to each other, and that starts in the home, and then hopefully permeates through business going forward. And if anything, this COVID crisis maybe has helped people to put themselves into each other's shoes.
Do you think we were having a discussion the other day? We are doing a bit of sales training, and someone brought up to me the old adage, which is in every business, relationship selling. Do you think because of Zoom and everyone having to do business like you and I are talking now, they've lost the skill to build relationships?
That's a great thing. But you know what, Rob? When we first met, and we've been speaking now for a number of years, I can't wait to come and meet you and give you a hug. Now, I had a couple of those situations where, if you remember, earlier this past year, I moved my family to Naples, Florida for about 5 months.
Yeah.
And people that I met on Zoom around the world, I invited them to come to my house. The virtual became the reality. So I think, like we're interacting here, we're still having an interaction. We're looking in each other's eyes. We're talking. It could be sitting across the table, although we're sitting across the world. Okay. Yeah. So those personal relationships remain. Okay. But the problem is the younger generation, the kids that have not been able to go to school, have not interacted. They're on their iPhones. They're on their other electronics. Okay. There's and now you can't shake people's hands and stuff. Okay. You got to elbow them or something like that. Oh, yeah. A whole generation, okay, has been more complicated now by these interpersonal skills, okay, that have been decimated over the last 2.5 years, and likely to continue so for quite some time. And for young kids, it's the formidable relationships. I'm talking about, my little girls that are 3 and 4 years old that have spent half their life under lockdown without other people interacting. That doesn't bode well for their, emotional and psychological developments. So, that has hurt. I think people that, needed to become more personal and interpersonal, et cetera, in terms of relationships, it could be grown adults or teenagers, et cetera. It's hurt there as well. So I think going forward, people are just going to have to make a much more concerted effort. And I think there'll be a great cottage industry of helping people to improve their interpersonal skills, their presentation skills. It's always been there, but I think it'll be more important now as people lost a bit of sense of that.
I couldn't agree more. My godson, he started university and he just finished 3-year course, international studies. He spent a whole 6 months physically at uni. So he missed the whole social side of uni, but he also missed the growing up that happens when you're at uni and all the fun and games that goes with it. Now, we're lucky he's a great kid, but he's had that massive chunk out of his life. Now, he's supposed to now go and apply for a job with a gentleman like you. He hasn't had all those social experiences of dealing with, in the real world, in the adult world, of not nice people that lie to you, people that are honest to you, which you get at uni. And he's going to come to a guy like you and they don't have those social skills. And that's exactly what you're talking about. It doesn't matter if it's a little girl or a young child at uni, a young child in high school or primary school or at uni. All these kids are going to have this, and it's going to take a lot of work by a lot of us, like you and me, to help these kids get through this and do our best to teach them the skills. So I couldn't agree more, mate. Before we wind up this lovely chat, with the people that have been listening, and there's a certain group that I know love listening to you when you come on our show, what would you say to someone who's trying to look for the next 12 months about investment and where you would think business, when it comes to residential, commercial, is going to take over the next 1, 2, or 3 years?
So I think, again, now, I'm not a financial advisor, right?
No, you're not.
I work at a large institutional investor. But I caveat that because when I first saw, I've been doing this for 35 years. And when I first saw the pandemic hit and I was not aware of the unprecedented monetary and fiscal response, first thing I did was call my parents and I said, go to cash, the world's ending. And it looked like it did. Okay. They still aren't talking to me. So that was probably the worst advice I could have given. So with that caveat, I would say I think we're heading into As I mentioned before, you want to be optimistic. It's 2022. The pandemic is hopefully behind us soon, and we'll learn to live with this new normal. However, there is certain frictions in the system that I think is going to make 2022 a very challenging year for investments. I think that started with the inflationary things that came from the supply shocks that we've seen around the world. We have the unprecedented monetary and fiscal policy responses leading to a longer-term increase in inflation expectations. We have a situation where, because of the supply shocks, food prices are higher, oil and gas prices are higher, and OPEC's going to have to do something with that. The low to middle income person, that's a huge tax on them. That's a true tax on them, and they're going to struggle with that. Okay, so if you're talking about we can't go travel international, but we do staycations and drive. Well, no, you can't, because it's too expensive now. So I think that's going to hurt. I think all those things are going to make corporate earnings are going to be more difficult to have the robust things that we've seen in the past. So financial markets are going to be a hell of a lot more volatile. So you need to look at it. As I always said, if you're going to invest in some stocks, you invest in the stocks that are, the Warren Buffett thing, good companies with good fundamentals, with good management, and you look at it from a longer term trend. You're not looking at it to buy your Bitcoin and next month it goes from 45 to 50,000, because it can go the opposite way pretty quickly.
Yes,
so
that's true.
I would say keep a little bit of money, maybe 10% of your discretionary earnings for those volatile things, but 90% of the monies you have for investment into more solid type of investments that you can take a longer term view. And like always, if you're starting out, take a percentage of your money that you get each week or month or whatever, narrow it down in terms of you're covering your basic needs, put a little bit in savings, and then put a little bit in the markets, and just don't look at it, just because it's a longer term thing. And the same thing, real estate is an illiquid asset. It's become more liquid in the last 2 years because people are looking to buy. But fundamentally, real estate is an illiquid asset. You buy real estate to live in your home. If you buy a secondary home, you buy that home to use it as well. And if you have the discretionary income to buy a third, fourth, or whatever home for that, again, there's costs involved. There's a lot of costs. There's mortgages, et cetera. There's taxes. There's maintenance that needs to be done. It's a long-term investment. It's not something you buy and look to flip in 6 months. It's unusual people make money in real estate buying and then flipping within 6 months. It's an aberration. So it's a longer-term play that you do. And you can participate in that without having to go and buy an actual home. You could buy publicly traded REITs or real estate investment trusts and use it through the market where you can buy and sell each day, if you want to participate in the real estate market that way with a professional money manager.
Matt, I remember I had the privilege of having dinner with a multimillionaire one day, and I said to him, what bit of advice would you give someone when it comes to investing? And he said 2 things. He said, 1, never invest with someone that says, trust me. And 2, do your homework. And this gentleman had started with absolutely nothing. And he'd made some mistakes along the way. But I went, wow. And that is what he'd lived his whole life by. So,
good advice.
And that was very similar to what you said. I mean, people need to do their homework. They need to only invest what they can afford. And they need to make their own decisions.
There's no free lunches, Rob. I mean, there were some free lunches given to institutionals and retail investors and stuff in the first 3 months of COVID, and then that permeated longer because right after COVID hit, saw this liquidity flush in the system, markets all went up, everybody did well, real estate homes went well, but the average person that didn't have that investment dollars, didn't have the real estate, did not benefit from any of that, did not see their wealth. They struggled. So there was a gift, there was a free lunch given by government monetary and fiscal authorities in 2020 and 2021 that will not be repeated. So you got to do your homework now and invest for the long term.
Now, before we wind up, normally I ask, who would you like to have at your lunch table, which you and I are going to have lunch in what we call the Opera Bar, which is under the Sydney Opera House one day. And we'll probably get in trouble from our wives for being there too long. But I'm going to ask you this. You've been traveling around the world the last couple of years. Where would you go if I said you could go anywhere tomorrow for a holiday?
Anywhere. I think I'd like to go to an island that you recommend and just kick back with a margarita and no stress, and just have some peace, because I think I haven't had a lot of peace in my life over the last couple of years. It's been a lot of stress, and I know that's been the case for most people. And so if we could take some time out and just have some stress reduction, I think that would be helpful for everyone. Right? Just take a time out. I think everybody needs a good time out. And a time out isn't because we had COVID, we had to sit at home with our families. Time out is a time out for yourself. Just put things back into perspective. So whether that's on an island, that would be nice, or just put some time aside to do so. Half hour a day, 20 minutes, 10 minutes a day, I think could go a long way.
I was actually telling a client just before Christmas to put 15 minutes in his calendar every day. And he said, what for? I said, to turn your phone off, to go and sit in the park and have your lunch. And he looked at me and he said, why? I said, because that 15 minutes will absolutely make your day, and you've got to have time for you. It's been an absolute pleasure again talking to you, Pete. It's an American living in London, so every time I speak to you, you're somewhere different in the world. So I don't know where we will be next time we have a chat, but thank you so much for your insights and your observations with what's going on around the world. It's been an absolute pleasure, mate.
And Rob, it's always a pleasure. And by the way, congratulations on the Sales Chain. What a wonderful book. And I encourage everybody to take a look at it. I'm biased. Obviously, I contributed to it, but I think it's a really helpful book, not just about sales, but basically human interaction and how to basically take knowledge from other people's experiences, their trials and tribulations, and learn from it. And you put it into a nice, easy to read, easy to reference book. So, congratulations on your dream.
Mate, thank you so much. That was the whole idea behind it. So a nice, easy one, not a high-end one. So it's absolutely fantastic, mate. And as we say at the end of every one of our podcasts, have a groovy day.
You too, buddy. Cheers.